macro shifts and AI revolution. We expect Mr. Vikas Khemani, the guest speaker of the webinar, to join us shortly, and we'll start the call in a couple of minutes. Thank you. Hello. Hello. Hi, Vikas.
Hi.
Hi, Vikas. Yeah, welcome on the call. A very good afternoon, everyone, and welcome to the exclusive session of InCred on investing through global regime change, geopolitics, macro shifts, and the AI revolution. Today we have Mr. Vikas Khemani with us, the guest speaker of the day. We all know that markets are clearly entering a new regime change, right? So geopolitical tensions, AI disruption, liquidity enhancement measures by the RBI, and the fluid macroeconomic environment coupled with the kind of the earnings growth trajectory related changes that we are seeing. So we thought it's a good time to get a pulse of the market, and who best to have on the call than Vikas Khemani, right? Mr. Vikas Khemani, as you all know, has close to around 3 decades of experience in the capital markets. He's the founder of Carnelian Asset Management. He established the firm in 2019. It's a boutique investment management and an advisory firm. It manages close to around 1.6 billion worth of assets across various portfolios. Prior to founding Carnelian, Mr. Vikas Khemani served as the CEO of Edelweiss Securities for around 17 odd years. So he had a wide breadth of experience across institutional equities, investment banking, and equity research. Welcome on the call, Vikas. Vikas, over to you. We are eager to hear out your take on the markets at this point in time. The next 20-30 odd minutes would be reserved for your take on the markets, and we can have the Q&A session at the end of the call. Over to you, Vikas.
Thank you, Shalin. Thank you for setting up this call, and good to connect with all of you. So as you were saying that, what do I think of markets, current situation? So I think we are of course at a situation where the sentiments are quite negative. There's a lot of impatience which is there within the investors that are 1.5 साल से कुछ हुआ नहीं है. But I will say let's first see what context we are in right now and how should we see the environment. So I feel every couple of years, current year, what we are going through comes. Very similar year was in 2022. If I kind of recall your memory, 2021 was a great year from a returns perspective. Most people had started investing only late part of 2021 because 2020 के बाद में everybody was skeptic. But 22 started on a very good note with the backdrop of 21, and then Ukraine war started. And that kind of put everything under question, and everybody in next 6 months turned out to be very, skeptic. Inflation went up, all those things were there, logistics kind of. So till September, markets were kind of struggling, mid caps corrected, significant correction happened across market caps. And September onwards, market started doing well. And there was no trigger, it just kind of started. And 23 turned out to be a great year as the uncertainty kind of, not went away, but the implication of that settled down. And 24 also started on a good note. Till September 24, market peaked out. But early part of 24, there was one interesting thing happening. Shaktikanta Das, our previous RBI governor, in order to defend rupee, he ended up creating a huge liquidity deficit. In April of 24, there was a liquidity deficit of about 3.5 lakh crores. That got coincided with the general elections. So, during general election, government does not release capital or payments. So as a result of that also compounded the liquidity constraint. Around that same time, RBI had come down heavily on this unsecured loan. So that also created liquidity squeeze. So all those liquidity squeeze ended up creating impact on the corporate profits with 2 quarters lag. So September 24 market peaked out, corporate profits were fine, and December corporate profits kind of fell because of the liquidity squeeze. right? So you had a peak market valuation, great performance, and corporate waking now, and that set the way for correction in the market. But fast forward, if you see, our new RBI governor came in December 24. First thing he did was remove liquidity deficit, cut interest rates by 100 basis point, add a lot of, I mean, he gave every statement which is growth boosting. So monetary policy, he gave a very good big stimulus. But at the same time, if you see, in Jan Feb market started stabilizing, but then we had Pahalgam attack, Operation Sindhu started happening, and there was a lot of worries, US, India, Pakistan war, and this and that, and it was clouded. Then we had immediately, US tariff things started playing out. So that was again a very big situation. So we had one after another huge impact on the, one in certain uncertainty coming about, and that, I think, in my opinion, was big situation. So I think that happened, and that continued to create uncertainty in our markets. To counter that, and then tariff things started, it escalated. Earlier we thought there won't be tariff, won't be much on India. It came about, then it escalated to 50%. That created uncertainty, and then the geopolitical escalated further. So we had one after another thing coming about. But look at government announced GST cut, which was another fiscal stimulus. So I think amongst all these things, what was happening, underlying economy was getting repaired, macro environment was still looking very grim, the news flow continues to remain grim. So you have fiscal stimulus, monetary stimulus, income tax rate cut, so all those things are working fine. And now we have, fast forward, all the FTAs in place. So all the uncertainties are one by one coming to an end. But market environment still is gripped with the fear, uncertainty, because the global environment still remains. Now, you saw IT news coming about in last 10 days, IT has escalated. So there's a lot of fear, uncertainty, which is prevailing in the market. So my view has always been that, you are sitting, market corrections have happened, froth has got cleared, frothy stocks have corrected 60-70%. So you are sitting on a very good setup where there is a earnings growth, there is a corporate earnings growth, last 2 quarters have picked up, there's GDP growth happening, GST collection happening, CV cycle has picked up, insurance premiums are collected, credit growth is better. So fundamentally, economy level, everything is improving and getting better. Market environment is clouded, valuations have corrected. So I think this kind of setup comes once in a while, and I always believe that this vintage should always help in terms of creating long-term outcome. In 2022 September, we had written a note saying, build this vintage. This vintage will be very good. And as you see today, even after all this thing, 23 vintage is 22 vintage is one of the best vintage from a return perspective, portfolio outcome perspective. So I would say we think that currently also that vintage is a really, the current vintage will be pretty much like 22. Now I don't know whether market will turn next week, next month, 3 months, 4 months, I don't know. We are currently fully invested. We think that fundamentals are improving, corporate earnings are improving. We don't see any reason to worry. There's no crisis for India. Our debt to GDP, banking system, inflation, fiscal deficit, current account deficit, corporate debt, all are in good shape. So there is no crisis which is brewing in India. So sooner than later this will settle down, and markets will kind of come back. So we are in a favor of investing into market. I know when the environment is bad, it sounds like contra view and sounds like very difficult, and clients generally don't get convinced when there's a 1.5 साल से return नहीं बना है. But that's the time to, in my opinion, look and aggressively push for, because our job as an advisor is to tell clients when the risk reward is more favor. I mean, looking at the hindsight return, and that investing is always easier than looking at the hindsight return when things have not come about and then still do well. So always look at future return than the past return. But investors tend to do other way around, and that is where you create the more risk. I would say right now that's a setup of the market, and we are quite sort of in that sense optimistic about the market. So this is my view on the market. And maybe it's, I am told by Tanay that today we have to talk about our first time we are interacting. So a little bit of update on the Carnelian, or many of you may not be aware about our whole journey, and I think some of the funds, so which are kind of being sort of uh, put by your product team to kind of recommend to the investors. So I'll chat a little bit more about that as well. But let me first give you a little bit insight into how we think as a firm, who are we, what is our investment philosophy, and then I will get into some of the two funds which are being launched. So Carnelian, as you know that we started in 2019. Before that, I was with Edelweiss for 17 years. I joined Edelweiss when it was 20 people company. Built several businesses over the years. Uh, 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 you know, uh, Investment banking, broking, research. Having 7, 8 businesses, and had a great time. But always wanted to start something of my own. So with that objective, I, Manoj, and Swati, we got together. All of us worked at Edelweiss together and started Carnelian. The only business we did not do in Carnelian, in Edelweiss, was manage third-party money. So we had no track record of managing third-party money. But we had a kind of approach. So with that, we went out. We could raise about 140, 50 crores that time. From there, we started our journey. Today, in 6 years' time, as we speak, we manage close to 15,000 crores across all our products, work with very large leading families of the country, Dabur, Havells, Pidilite, TVS, Wipro. Across the country, we have very good client roster, almost about 6,000 odd clients. And, we are about 100 people team in size, having offices in 10 cities. We have on-ground people from onboarding and sales support perspective. Investing team sits in Bombay. Uh, so this is broadly, and our objective of starting Carnelian and whatever we are doing is not to really only kind of make some money and collect some AUM, but we want to build something which 10, 15 years down the line we can look back with a lot of pride and satisfaction. So that is the real uh, objective with what we are doing. And it's important I am sharing this because I think any partner who partners with us should know our motivation, should know our intention, our approach. Now, coming to our investment philosophy, which is the most important aspect. Outcomes, results can be in and out, but investment philosophy is the most important aspect of any investment house. So let me spend about 5 odd minutes on that, and you will understand, how we think, what we think, and how we operate, and how we select stocks. So if I were to tell you in one line our investing philosophy, it is quality growth at a reasonable price. So you look out for quality growth at a reasonable price, right? Now let me elaborate more in detail. It sounds cliched, everybody says the same thing, right? So I can very well say that. But here is the detail. Whatever we do rests on two pillars: growth and risk. Let's first talk about risk because we are in the business of taking risk. And then I'll come to growth. So we have two core fundamental beliefs around risk. Number one, you should take risk only when the risk reward is in favor. And number two, you can manage risk very well provided you know the source of risk. Risk aati kahan se hai? From that perspective, the source of risk perspective, we divide risk into three parts: type A, B, type C. Type A is a risk of permanent loss of capital, meaning after you invest, you lose 80 to 100% of your capital, never to come back. Very, very important risk. Nobody wants to lose capital. And the source of this risk comes only from two sources. One, either you ended up betting on a poor quality of the management, kharab aadmi pe rupiya lag gaya, or you ended up betting on a business which is prone to disruption. These are two sources which leads to your big capital loss. Now, around this, we have a core capability. One of the things which we did in Edelweiss also in 2007, first time we started in India, forensic research capability, that we have built further. So before we invest into company, we have built systems. If I put a ticker of the company, it pulls data from different sources and tells us what are the red alerts. That is how we start investing and working on a company. Then we meet management, do plant visits, speak to employees, ex-employees, vendors, auditors sometimes, depending on how deep we want to go. But our biggest promise is that you should not find corporate governance into our portfolio. So type A risk is something we'll never take. Then comes type B risk, which is risk of mark to market or volatility risk. Meaning after you invest, you lose, temporarily stock prices go down. What has happened in the even recent past. Source of this risk could be political, geopolitical, any news flow. How we saw, I was talking about, Pelgam to tariff to all those things create volatility. Very, very relevant for day trader or a leverage player. We don't do both, hence we don't spend much time on this. Then comes third type of risk, which is risk of mark to market, risk of opportunity loss. Uh, it means you should have invested into stock A, sector A, but you invested in stock B, sector B, thereby generating suboptimal return. Now, technically speaking, it's a notional risk, money you could have moved, but we think it's a real risk because every person has a limited capital. On that limited capital, you are supposed to generate superior risk-adjusted return, right? So the source of this risk is again twofold: lack of knowledge. If you don't know where the opportunity is going to be, how will you tap into it? And secondly, long-held human biases. Those biases come in our way of acting rationally, and so these are the two things we work on. So type A and type C. This type A allows us to protect capital. Type C allows us to outperform market. These are two risks we work on. Now coming to our second aspect of the effort, growth. So growth is something, we look at it in two parts, what we call magic basket and compounder basket. What do I mean by magic basket? In magic basket, we invest into companies with a view to capture earnings growth and valuation re-rating. When both happens together, you make a lot of money. EPS bhi bade or PE bhi bade, right? That is what we are looking in this. Now, $1 billion question is, how do you identify companies under this? How do you consistently year after year? That is where we have created our own proprietary framework. At any point in time, you monitor 80 to 100 ideas in this. I'll give you some idea. So usually this happens in about 8-10 situation. One very common situation when it happens is good business, poor CEO, poor management, change of management happens. And if you believe after doing your work, new management can address the issues of the past and deliver growth, then you end up doing both earnings growth and valuation re-rating. For example, when we started in 2019, our largest holding we bought was ICICI Bank at 280 rupees. Sandeep Bakshi joined in October 18. Before that, bank had a particular situation. For 10 years, it gave zero return. When we met in May 19, we were super impressed that what he was able to achieve in 6 months' time. He was able to change the culture and strategy of the bank. We were so convinced at one time book that we bought 10% of our fund. So today, the bank, from cheapest bank to most expensive bank, 5 years of consistent track record delivery quarter after quarter, right? So this is, and that time, there was not a single person at ICICI Bank. Everybody's top holding was HDFC Bank, right? So this is what you look at when you are looking from, good business, poor management, change of management happens. And that is how we have done, Cipla at 400 rupees when Umang came. Good company, but poor focus on financials. He brought that growth. Aditya Birla Capital we bought at 100 rupees when nobody wanted to buy. We were the first institutional investor buy after Vishakha Mulay moved there. And our conviction was that she will be able to turn it around. And, today stock has gone from 100 rupees to 350 rupees in less than 3 years time, from one time book to 2.5 time books. So this is how Mahindra and Mahindra we bought when Anish came, at 600-700 rupees. He has kind of brought a lot of focus on ROE, ROC, capital allocation, all those things. So time and again, such kind of opportunities keep coming. So this is our one aspect within the magic basket. Maybe I will tell you one more aspect where this magic event or re-rating can happen, acceleration in the earning and re-rating can happen. Is whenever you think there's a structural change happening in a particular sector or a theme which is going to last 8, 10, 15 years, then you identify leading companies in that space. For example, post-pandemic in September, October 2020, we picked up two very big structural change, namely manufacturing and technology, right? And we bought many stocks, Pras, Tube, Ratnamani, Laurus, many, LTTs, many stocks we bought which are 8 to 10x from then. In fact, our conviction was so high that we launched a separate strategy saying two shifts are happening, manufacturing and technology. And that strategy, all of you might be aware that has delivered phenomenal return over almost 30-32% CAGR for last 5.5 years with the alpha of 15%, right? So, now everybody launched manufacturing in 23-24. We could see the trend and launch in so much ahead of the time was because of this magic basket framework. So we basically trying to figure out what is accelerating much ahead of the time, what is changing much ahead of the time. So this magic basket framework is a very, very differentiated framework where we pick up stocks based on the rate of change framework. Second basket is what we call compounder basket, where you invest into companies only with a view to capture earnings growth. Valuation re-rating may or may not happen. If it happens, it's by fluke, not by design. So here, typically good companies, good ROE, good cash flow, and can grow at 15-17% for a long time. Here, actually, identifying name is very easy. Anybody can tell you. I think many portfolio managers also specialize in that. But here, the most difficult thing is to identify risk. Here, the biggest risk is risk of de-rating. That the stock can get de-rated. So, like for example, in last 6 years, not only we never bought, but every meeting I went, we have said with logic why HDFC Bank will get de-rated, right? Now think about it. In last 6 years, HDFC Bank has given close to zero return. ICICI Bank has given 5x return. Classic Type C risk. Our risk of opportunity loss. We never bought Asian Paint. We never bought Bajaj Finance. We never bought many companies which has got de-rated. Aptus, which Mediplus. Many which are companies market's favorite darling. In terms of So in investing, basically you have to identify companies which can get re-rated, and you have to avoid companies which can de-rated, right? So that is the whole thing which you're trying to do. So this is our broadly investment framework, investment philosophy, which has obviously resulted in terms kind of performance which you see over the years across our product. Our performance has varied from 4% per annum to 9% and 15% per annum over last 5-6 years, depending on the product to product. So I think this is our broad investment philosophy. The product which are being launched is Carnelian Compounder Strategy and Bharat Amrit Kal Fund. Now both are basically flexi cap funds. Compounder, the only difference is the compounder strategy is PMS and other one is a AIF, and both are kind of other than that approach is same. Portfolio will be more or less in 90-95% same. Sometimes difference can be because of some anchor allocation we get and all those things which can be done in AIF, not in PMS. Other than that, there's not much difference. So of course, compounder strategy has been for a very long time. And Amrit Kal we launched earlier. We had a compounder strategy in AIF which was close-ended. So Amrit Kal was the fund we launched as an open-ended AIF so that people can keep topping up. Many of our clients have been telling us that we can't top up, so hence you launch an open-ended product. So that's how Carnelian Amrit Kal Fund was, Bharat Amrit Kal Fund was born. And so there we have two products. One is Bharat Amrit Kal Fund 1, which is with a 5 crore minimum, and Amrit Kal 2 with a 1 crore minimum. Right, and and same thing is available offshore also, India Amrit Kal. So and in PMS it is. So across all product, all formats, you try to make a product available so that you can tap into whatever client base you want to tap into. Other thing, and all I can tell you, this broadly invest into 5 broad spaces. Amrit Kal Fund: manufacturing, banking, financial services, consumer. Services and infrastructure. Within that, we try to pick companies. And other interesting thing about our portfolio outcome is that we say faster, stronger, cheaper. Meaning our portfolio companies should grow both top line and bottom line on faster than the benchmark. So as you can see from the chart displayed, our earnings growth is faster. It should be stronger on ROE and debt to equity ratio. So you can see ROE is about 17.5%. Debt to equity ratio is almost negligible. And should be cheaper on PEG basis, and the beta of the portfolio is lower than 1. So we tried to deliver better return after taking the lower risk. So we have outperformed. As a fund manager, 2 things we can do as a long only fund manager: generate alpha and reduce risk. And that is what we've been able to achieve over last 5-6 years. I will pause here and happy to take any questions.
Yeah, thanks a lot, Vikas, for the detailed take on the market and the bits on the strategies which are very much suited for the investors at this point in time, right? So, Vikas, just to start with the Q&A session, people please feel free to log in your questions. The tab of the Q&A is placed at the bottom end of your screen. So, Vikas will be more than happy to address all of them. Because given the context of the AI-led disruption, right, and this is the kind of question that we often get asked, right? So how is India positioned at this point in time when it comes to handling the AI-led disruption? the kind of correction that we have seen on the IT space on the backdrop of all the launches around, Anthropic, cloud. What's the take on the sector at this point in time, and how are you positioning your portfolio?
So thank you. Very common question these days. No call. It's like about 2 months ago, 1 month ago, there was no call which got completed without conversation on gold. So now this can't be completed without conversation on AI. It's the theme of the day and hour and time, and rightfully. So the way I see, of course, AI is here to stay. It's a very big disruption. It's a very big change. But I see more this as a hope and opportunity than the threat. The reason being because every time technology transition happens, there are our human lives get better, and it's like internet. Internet came; it was a very big change, by the way, but it made human lives far better. Access to so many people, information which was never there to them before. Right? We could before also travel from one place to other place without Google Map, but today we can't think of doing without that. Now, has it made our lives better? Yes. We could do Zoom call today. I'm not in Bombay, but we could connect to so many people, online. Now that's only because of internet. But if somebody were to make a case that, oh my God, because of this, now airlines or travel will go down and airlines will kind of start losing the business. It is that kind of case, right? Now today, airlines and volumes have gone up because Zoom call can only make life easy, but that's not going to reduce the travel. Same way, this time around when the AI has happened, every IT service company will have to adapt, readapt. वो सब करना पड़ेगा उनको और वो कर भी रहे हैं. But in enterprise context में, just think about it. Let's say in your company, you have to implement AI related tools. Who will do it? You'll have to engage with some IT services company only. So like when you were implementing SAP in your company, you need IT company to implement that. Same way, all these companies are going to implement tools and they will come and understand your problem, implement tools. Now, some people will become irrelevant, but IT services will grow. Some people might not, you might not same amount of people. That's a different problem. But IT services will be here to stay. In fact, I met a couple of CEOs also. I asked one question: 5 years down the line, do you see IT industry bigger or smaller? Everybody said without far bigger than what it is today, because we all use more technology, and more technology disruption means, in enterprise context, you need consultants, enterprise companies, IT services companies to help you doing that. Because in a professional setup, in enterprise context, owners, managers can't do themselves. So all these IT companies will adapt according to me. There is a transitionary phase which will happen. Some companies may not be able to adapt. Every cycle there is a new like Y2K. A lot of people wrote off IT services industry after Y2K कि अभी क्या है. उस टाइम पे IT का इंडस्ट्री 10 बिलियन का था, आज $280 बिलियन हो गया, right? So they came to ERP, they did ERP, then cloud, then digitization. So once you start, it's irreversible path. But every cycle, new companies come. In 2000 cycle, Infosys, Wipro, Satyam became big. Then in 2009 to 20 cycle, HCL Tech, TCS, Persistent, LTTS became big. So every cycle, new companies get created. Where was LTTS in 2000? No, they were not even around. But Persistent was a tiny mini company of like 100 crore types. But Persistent became 80,000 crore market cap from 2009 to 2019, from like 1,000 crore, so 80x in 10 years. So every time, so I do believe इस cycle की कुछ अलग कंपनियां होंगी. Some will adapt. Like Coforge CEO, I have tweeted today. You should go and listen to his speech. He said, I will become a large cap company. I am ready for AI. I mean, that's what statement he's making very boldly. Now, he's putting out his neck out, but I'm saying he may or may not be able to do it. But I'm just saying that he's sticking his neck out and say, I will build a company which is AI ready, AI native. I'm already building. So all those things will happen. So I think we are watching carefully. There's a risk of stock getting derated if the perception around the IT changes. So we are cognizant of that fact. We are underweight IT right now. I mean, for last many quarters, we have I think 6-7% weight, and companies which are better placed in the whole ER&D and product companies and all. But still, we have taken some knock on that. But I think by and large, in my opinion, damage is done. How much return and all we made, I think it's like, and again, a very good example I'll give you. In 2021, there was a no call. There was a very big narrative, and every call I had to answer. That narrative was fintech will disrupt banks. this was a common narrative that fintechs will disrupt banks. CNBC, this question used to be all the time. Lata Venkatesh used to lead this. And I used to say that in a bank, brand and trust is far more important. Now, between fintech and bank, who will get that? Where will you get your money? So, if will fintech be able to buy brand and trust, or will bank will be able to build technology? I would say that odds of second one is far better. And today, nobody talks about fintech. Everybody talking about only banks, banks, banks. So all those things happen. So I would say right now the narrative is a bit exaggerated, and that's the reason we are feeling such a pain in the market.
Sure. So, because another question that often gets asked is, in the midst of all the global volatility, right? So, one common, strategy that most of the fund managers adopt is geographical diversification, right? So, one of the questions that's been asked by our clients is the view on the US markets and the emerging markets like China and Taiwan. And would you recommend the investors investing into such kind of markets?
Dekho, boss, everybody has their own view, and I'm sure I can give my view, and I reserve my right to be wrong. But I personally believe, when you see 5-10 year view, look at the macro things. Macros are most important thing to look at from a setup perspective. Let's first look at what we have in India, and then you'll compare this with what we have in other part of the world, whichever world you want to pick up. We are the fastest growing GDP in the world. We are the youngest demography with 28 years of median age. 2/3 of our population is working age. China is 38 years median age and getting old. Tell me which country is getting younger? Every country in the world is getting old. US with migration issues, immigration issues, and all those things still getting challenged, right? So your banking system is very strong. Your fiscal deficit is controlled. Your current account deficit is controlled or getting down. So if I look at the macro factors of any economy, right, India is so well placed versus now look at US, and you are today less than 2% of the world's market cap, or 2.5% of the world market cap. US debt, and in case of India, I forgot to mention that debt to GDP, corporate debt to GDP is like lowest in in like any country you can comparison, right? Our credit debt cycle has not even begun. Now, flip this all, what is happening in the US? US's market cap is 67-70% of the world market cap. Extremely leveraged balance sheet, extremely leveraged, debt situation we see. Growth slowing down, inflation, with all this tariff and all uncertainties are picking up. All the third world problem which we used to earlier say about India are being seen there. Poor infrastructure, inability to take more debt, hence inability to invest into anything, right? All those things are there, right? The good news for US is, of course, the world capital goes there, and hence, hence they benefit. Coffee, right? Without sugar coffee. So that gets benefited, right? So what I'm saying is that now you can figure out, that talks about AI bubble, this and that. So according to me, odds are not in favor of investing anywhere else when you're the best market today in the world is in India, right? China, despite 10% plus GDP growth, 20-year return of China is almost negligible of 2-3%. 20-year return. Despite all the chaos in India, whatever chaos we have, 20-year or 25-year return in India is 17-18%. So what I'm trying to tell you is that India has always delivered. Our demography, our democracy are the very big strength. Now, if somebody wants to park 5-10% of the capital outside, how does it help? It's not going to make any material impact anyway on your portfolio. So my point, I am always big believer, and I am a big believer that India is one of the best market over next 10 years in the world. Now they will, in a 10-year history, there will always be periods of last 1 year, 2022, आते ही रहेगा वो तो. If you see, Nifty 2002 के अंदर 800 पॉइंट था, आज 26,000 पॉइंट है. It is 17-18% return. Now in this period, all kind of problems have happened. We have seen 20-30% market correction. We have seen 2008 crisis. We have seen demonetization. We have seen ILFS crisis. We have seen general elections. We have seen state elections. We have seen presidential elections. We have seen pandemic. We have seen every possible potential risk which could come have come and gone. and those risk periods markets returns were poor. But if you look at, over a period of time, it has delivered, created wealth. $250 billion market cap has gone to $5 trillion market cap, which very few economies can claim to have, right? India is the size, scale, high growth market. It will remain so for next 10 years. If somebody, clears the cloud and then think, I don't think there'll be any problem. But somebody say, oh, dekho, last, a lot of people see what happens is typically people look at it in hindsight and then decide. Most people want to invest into Europe now. अरे यूरोप का अभी रिटर्न चलने के बाद में क्या इन्वेस्ट करोगे? Most people want to invest into Japan now. Invest into, so fact is that Europe में which country is getting younger? Which their problems are wait. What I am talking about, opportunities of our country, all of them are reverse there. So now anybody who wants to think peacefully from a 10-year perspective, yeah, can it do a 1 year? Yes, but उसका तो किसको timing आना चाहिए, समझ आना चाहिए. So I think this whole romantic notion of diversification abroad, I think it might have been too early in the cycle. I mean, when I always jokingly say कि boss, सबसे best market which you understand is your doorstep. तो जब अपनी बीवी इतनी सुंदर है तो बाजू वाले की बीवी को क्यों देखने का है?
Yeah, so on that note, Vikas, you play, some of those themes, the 5 themes through the Amrit Kal, AI, right? The question that's been asked by one of the clients is the view on the next decadal theme, right? Barring the two, like manufacturing and technology, which you play through your shift strategy. Vikas, you are on mute.
So, excuse me. So I think themes will, broadly speaking, those 5 buckets I said, manufacturing is going to be a very big theme that we have spoken multiple times in various forums. Other big theme is, of course, consumer. As our per capita income goes up, people will spend more on things which more new, better. Right? Whenever our income goes up, we spend, right? So discretionary part is going to do well across various product mein, experiences mein, even in the sort of on the services side. So across all, you will see that within that space there will be a lot of opportunities. Today there's a very good demand in the premium end of the products in the consumer space. I think luxury products are just coming about. So there are many premium end of the stories in the consumer. In my opinion, that's a very big theme one should play over next 5-10 years. Then there will be people are spending more on experiences than actually only ownership, and around that there will be quite a few opportunities and themes. But generally speaking, I mean, I can create a sort of broader narrative around it, but there's a reason why we put these 5 buckets. Within that, we should be able to pick up things, whether it is outsourcing theme, whether it is component manufacturing theme, whether it is experiences theme, whether it is consumer spending more theme or financialization theme. Like within PFSI also now, 20 years ago, there were only public banks, then private banks came, then insurance companies came, then brokers came, then wealth platforms came. So as the economy evolves, more and more opportunities come from tapping market perspective. So hence you will find now asset management within asset management, alternative asset management are coming public. So you will keep seeing things evolving, things playing out, and all you are seeing is that as economy evolves, you are keeping your eyes open. We never believe in, it's like EV is a big thing, but tell me one EV company which has created value for any investor. It has only destroyed. I don't see a single EV company which has kind of made money, but everybody wants to invest into EV. Now that does not work, right? So many times themes don't mean anything. Themes only mean nothing when I can get a playable opportunity which can deliver me returns, right? So we keep eye on that. Defense is a big theme, but defense mein agar if you end up playing crazy valuation, you will not get something, right? So you have to find right time, right opportunity in the themes. There are many themes I'm telling you which are decadal, because in India, if your current GDP is $4 trillion, it is going to $10 trillion. everything will have to grow, and there will be new sectors which will come out, like I talked about manufacturing, which will come about.
Yeah, sure. So, Vikas, one last question from our side. Given the stellar rally that we have seen in the bullion space, the gold and silver, right? One common question that the investors tend to have is there more, juice left in the story, or is it over? Is the commodity rally over? So, what's your take on both gold and silver?
See, I don't have a definite, answer to that, because and I'm no more gold expert. But see, gold tends to move in spurts. Now those spurts come and go, right? Have you seen golds have history of 4-5 years no return, then 2-3 years doing well, right? Now that depends on a lot of macro factors. It's all result of right now a heightened tension between US and China, and poor view on US economy. Now that also partly answers your question about US market a little bit, while we are speaking about why does world who was earlier putting money into US dollar safely wants to diversify away, because the US dollar dominance is expected to be questioned. Now whether they will be successful or not successful, the fact is that today it is very much similar to whether IT companies will be around or not, or US will be around or not. That only will know in time. But fact is that today there's a belief that US dollar is under threat, and that's the result. People are buying gold and this and that. So how long it will continue? Can it continue some more time? Answer is yes. Will it continue? I don't know. So after a large part of the return is already coming, to allocate fresh capital, according to me, probably may not be wise. Very often, it is very comforting to invest after looking recent returns, because there's a behavioral bias where it's easy to kind of buy things when they are sort of very, in the recent past, they performed well and all. But that's where I think, in my opinion, when the risk happens. So I would say that physical commodities all look good, but will it perform the same way as it performed in the recent past? I don't think so. And but take my view with a pinch of salt. Not that I'm a great expert in commodities.
Understood. Understood. Thanks, Vikas. Thanks for those brilliant takes on the market. I'm sure the attendees have a lot of takeaways from the session. Your views on the markets and definitely on the strategies, both Amrit Kal and the capital compounders make a lot of sense now. So do consider all both of these strategies for inclusion in your portfolios. Uh, you know. Do watch out for more such exclusive webinar sessions from InCred Wealth. We have one more session coming up pretty shortly with Mr. Sanjay Chawla in March. So thanks a lot, Vikas. Thanks for that insightful session. That concludes the call, people. You may please log out. Thank you.
Thank you. Thank you.
Have a very good day. Bye.
Not already.